provided in the booklet, which to show that, as you can see, the lower the price percentage of the book value, the higher the average return for given for 4 holding periods. And if we look at the criteria like Benjamin Graham provided, the stocks also generate higher return compared to the higher percentage of the book value, which suggests that low PB ratio is a good indicator, might be a good indicator of the undervalued stocks. And then the booklet go on to provide studies to analyze the PB ratio, see whether the assumption, which is the good indicator of value undervalued stocks, holds true for given period. The third characteristic is the inside accumulation or stock repurchase done by the company. So the main idea here is for management, they have inside information about the company, and also they know the true value of the hidden assets. So when they believe the market underestimate the value of the company, they will start to accumulate their shares, or as a company to repurchase shares to maintain their stock a appropriate level. So that will be a good indicator for value investors to see if the management if the management has the confidence in the company. And then the fourth characteristics is the recent price drop. There's a nature law called the reversion to the mean. So when news come out and then the price drops significantly, it's a higher chance that the market value will be less than the intrinsic value of the company, and that's where the margin of safety exists. And for value investors, there will be a good opportunity to invest and then make profit. The fifth characteristic is the market cap. As we mentioned earlier, during the first and second characteristics, they all study the relationship between the low PE or low PB ratio between the market cap. During that study, those shows the smaller market cap, the better the return, because for smaller market cap companies, it is often with higher growth rate, and then for smaller companies, they are more easily be acquired by other big corporations. So when they be acquired by companies, and then the stock price will most likely to increase, which will provide a profit for the value investors. So now let's use some real example to see whether those characteristics really works. And here I just used the first two characteristics to show their comparison because it's more easier to measure. Here I have 4 value investors, Tully Brown Company and Warren Buffett, Ron Barron, and Mario Gabelli. And these are the stocks they invested. As you can see, if the small axis indicate that